So the end game is here. No more weeks ahead. It's last session is next session. Your project is due on Monday at 5. So presumably that's happening. But along the way, that Excel spread, the summary spreadsheet that I sent you, if you can fill in the numbers for your company, and I'm not asking for much. I'm asking for your DCF value, your pricing, and your recommendation. If you can get that to me by Sunday night, because it's going to become the basis for what I'm going to do on Monday, because I'm going to feed you back what you found. Right? So you're going to see how, and I'm going to compare what you found relative to other classes, 2018, 2017, 2009, 2000, 1998. So you can see how the classes have shifted in terms of percentage buys, percentage sells, undervalued, overvalued, underpriced, overpriced. So try to get it into me, but because I have to take what you send me in your Excel spreadsheet and put it into a big spreadsheet and do the summaries and make it into slides, I need some lead time, because Monday is going to be a hellish day, because I'm going to do corporate finance in the morning and have all those summaries, and I've got to do this. So the earlier you send it to me, the easier you make my life. So you don't have to wait till the very last moment. But I will leave the window open till probably midnight on Sunday, because that's about as late as I can hold off. And then at midnight, I have to basically start to create the summary sheets. It's not, there's obviously a grade is not affected by you not turning it in. But if you can, the more summaries I can get, the richer the analysis can get. I would prefer that you turn in one summary for the entire group, because it means less cutting and pasting for me. Okay, so if you have 6 people in your group and only 4 people are done and that's all you can send, I'll take the 4 rather than none at all. So if you can do even a subset of your group, because that's all you can pull off by Sunday at midnight, I'll take that as well. Right? Then the rest of the week, your regular final is a week from Monday. May 20th is the official day. Okay? But if you want to take the earlier final, which quite a few of you have signed up for, I noticed that the number is up to 70-something. Okay? The May 14th day, I think there might be a few more slots left, but we're very quickly running into capacity constraints. Okay? So if you want to sign, absolutely do it on May 14th. Go and put your name down. And if you put your name down and you've changed your mind, take it out, because it's not fair to hold up a slot if you're not going to use it. So don't use this as an option of just signing up just in case you feel like you wake up on May 14th, I'll take the exam today, because that's not going to happen. I'll tell you up front, it's not going to happen. Nobody wakes up and says, I feel like taking an exam today. So you either have decided already or haven't, but don't hold out that option. And the exam will cover everything. I sent you the review session for the review webcast for it and final exam, so you can take a look at. Don't let the amount of material put you to a point of you don't even try. You say, this is too much, I'm not even going to try. Start and work backwards. That's my suggestion. You know what I mean by work backwards? Start with the real option section, because you haven't done any of that stuff yet. Start with those problems. Then as you work through acquisition, valuation, value enhancement, you know what you're going to discover? That you're reviewing much of the stuff you did in quiz 1 and quiz 2, because what's an acquisition? Right? It's discounted cash flow valuation in a different data. So you're going to find that even if you work with the material post quiz 3, which is 3 weeks, that actually does a review of 90% of the material that we did for the class. So rather than start with the first session and work forward and end up not reviewing options, my suggestion is work backwards. Okay? So today we're going to kind of put the bow on the present, basically. We're going to tie up everything in this class. And this is where, how many of you are in my corporate finance class as well? I see, this is where corporate finance meets valuation. Okay? So what we're going to talk about today is, up to this point in this class, we focused on valuing companies from the outside in, right? You know what I mean by the outside in? You look at a company, you take it, it's managed by whoever it's managed by, and you value the company as is. Today we're going to go on the inside, and we're going to ask, if we wanted to change the value of a company, what would we need to do? So let's do the start of the class just built around that thing. So I'm going to list out a series of actions for companies, and I want you to tell me which of these actions will change the value of the company, will increase the value. Okay? It's a value enhancing action. A stock split. Does a stock split change the value of a company? Okay. What does a stock split do? Just changes the number of shares in the company. Stock dividend, same thing. But let me ask you a different question. Could a stock split affect the price of your stock? Yes. Why? Behavioral reasons. Maybe you think less is cheaper, right? If I do a 5-for-1 stock split, maybe it's liquidity reasons. Maybe lower price shares. So it could affect price, but it doesn't affect value. So today we're going to talk about the contrast. Are you enhancing value, enhancing price? Because we're going to find out that most CEOs, when they talk about value enhancement, really don't care about value. They want to increase the price. Okay? Second, amortizing goodwill. You said there's a tax benefit. What's the tax benefit from amortizing goodwill?
Goodwill, my profits go down.
But the tax guy is not going to let you claim it. You can impair as much as you want. The Daycraft Times impaired billions of dollars of goodwill. They got zero tax benefits from it because unless it's a very special kind of impairment, you don't get a tax deduction. Impairment of goodwill to me is one of the biggest wastes of time of all time. You have all these accountants gathered together. Impair goodwill. What do they tell you? Oh, 2 years ago you made a mistake. Guess what? We all know. Now you come around to my point of view. If I don't get a tax deduction, it doesn't affect my cash flows. It's already happened, so it doesn't affect my growth rate. It doesn't affect my risk either. It's already done. So unless there is a tax saving from goodwill, as I said, some types of impairment you might have it can't have a value effect. And if it does, it's purely coming from the tax consequence. What about changing depreciation methods? Remember, in the US, you're actually allowed to have two sets of books. It's legal. There are your tax books and your reporting books. The way you measure income in your tax books doesn't have to match up to the way you measure income in your reporting books. Don't ask me why this is even conceivably allowed, but it's allowed. So here's what you decide to do as a company. You decide to change the way you estimate depreciation, but only in your reporting books. You're saying, why would I do that? Well, remember the accelerated depreciation. You get a big depreciation expense. It makes your income look lower. And let's say your analysts are lazy. They supply a PE ratio to whatever your net income is. By switching to a straight line depreciation, what happens? You report higher income. That lazy analyst applies 20 times earnings. All of a sudden, magically, your company's value goes up as well. But does it affect value? It can affect price, obviously, because people are sloppy. But if you think in terms of cash flows, you've changed the depreciation method, but the cash flows are driven by the tax benefits of depreciation, not what you report. You might mistake their cash flows because you're using the reporting books, but the value is not changing. In the late 90s, you had companies also issue what were called tracking stock. I'll give you a classic example. New York Times created a NewYorkTimes.com in the 1990s. Why? Because it was the age of the .com. And then they issued tracking stock. Basically, they issued shares that supposedly tracked NewYorkTimes.com. It's the same company. And the thing about tracking stock is you have no corporate governance rights. There's actually no board of directors protecting you. It's just saying, the company's saying, look, we've created a part of the company that's in this great potential business. We're going to let you buy shares or basically have tracking shares on that. You don't have any control. You can't change the corporate governance of the company. Essentially at the mercy of the parent company. You're still the same company. So if you valued New York Times yesterday, valued today, all that's changed is now they've created a class of shares called tracking stock on a subset of the company. Can it change the value? The answer is no, because it's still the same company, still the same cash flows. They might be giving you a signal about the future, and that might affect how you price them, but it shouldn't affect value. Yeah. It's really a complete charade, if you ask me. Basically, because it looks like a stock, it has a number attached to it, but it comes with none of the advantages that you get with equity ownership, right? A share of the earnings. You can get a share of the earnings, but who decides the earnings? The New York Times decides, and who controls how they allocate expenses? They do. So you're completely at their own. Today, you know what the new trend is that people are trying to carve out in the companies? It's users, members, subscribers, right? So you have all these old established companies saying, we have a user base. We're going to create a tracking stock to show you how much money we can make on our users. So the answer is none of the above. None of those actions affect value, but all of them can affect the price. So today we're going to start with that contrast between value enhancement and price enhancement. And with value enhancement, it takes a lot of work to actually increase value. So let's say you decide to go the value enhancement path. You now are the new CEO of a company which has 4 divisions. There are the 4 divisions. I've been very creative, called them A, B, C, and D. There are the returns on capital at these divisions and the cost of capital at these divisions. So you have 1 really bad division, 1 neutral division, and 2 good divisions. This is not uncommon. You're probably going to see this in any company. You're thinking about selling one of these divisions. The answer seems obvious, but I want you to think through it. If you're going to sell one of these divisions, which one would you sell? What's the obvious answer? Get rid of the bad division, right? But what is the effect of a divestiture on your value? It's what you get when you sell the division relative to what you'd have made by keeping the division yourself, right? So this is a bad division. The whole world knows it's a bad division. You try to sell it. What are you going to get as you divest in a divestiture? You're going to get what people think about this bad division with its terrible returns on capital. When you think about divestitures, people often think about selling off the worst parts of the business. But you know what you should be selling? You should be selling those parts of the business where you're most likely to get a price higher than your value. And guess which divisions are going to be most likely to have that characteristic? Not your worst, but your very best. People are more likely to overpay for star divisions than dog divisions. But if you look at any restructuring, the action always is, let's get rid of the bad businesses. Hey, you're right, you do. But your problem was, your mistake was 25 years ago entering into these bad businesses. You can't that easily get out of them. So today we're going to talk about divestitures and what effect they have in value. It gets really messy because you have to compare what you will make by holding on to this division. Because remember, even that bad division has positive cash flows, right? It's really low, it's much lower than it should be. So if you value that division to yourself, that might still be higher than what somebody's willing to pay you. And let's talk about financing decisions. The company has 200 million debt, 800 million in equity. Its optimal debt ratio is 20%. Right? So basically, it's already at the optimal. The CFO says, look, no, nothing we can do. We're already at the optimal debt ratio. Is that true? That once you got the right mix of debt and equity, there's nothing more you can do to change your cost of capital, at least in the financing dimension. What else can you look at? What? The maturity of the debt, the currency in which, keep going. So if you find maturity of the debt, currency of the debt, what do you do next? In other words, if you have debt that's mismatched against your assets, even though you're at the right mix, you still have too high a cost of capital. Why? Because you're exposed to default risk. So you're a Turkish company, and all your debt is in euros, and your cash flows are in lira. Even though you're at the right debt ratio, I'm going to tell you that there is something else you can do to lower your cost of capital, which is, hey, get rid of that mismatch, either by replacing your debt or by using futures or forwards or derivatives to kind of get rid of that mismatch. And finally, let's talk about buybacks. Let's say Google has 60 billion in cash balance. Now it's up to 100 billion. If it decides to return 45 of that 60 billion in buybacks, will that leave you better off, worse off, or unaffected as an investor? And what does the answer depend on? I mean, this is a big question, all right? You see these big buybacks. I'm sorry? In theory, let's stay with the why in theory are you unaffected? Isn't the value of the company going to go down the minute they do the buyback? Yeah, because the value of equity in the company will drop by roughly 45 billion, right? So isn't that bad? Your equity is worth less. Well, you have the $45 in your pocket. So if you think about a pure buyback effect, all that's changing is instead of the money being in the stock price, it's in your pocket. So in theory, but tell me why in practice it might be different. Tell me the scenario where it's going to be bad, and then we'll do the scenario where it's good.
It's probably going to be bad when your stockholders interpret this as the company doesn't have any more good projects.
One is if you're sending a signal with this buyback that affects expected growth, and you say, look, because their expected growth is lower, or you're a company with a capital constraint, not like Google, but you're a company with a capital constraint. You do a buyback, and by doing this buyback, you now are capital constrained and can't take the projects. So there is a bad news potential where if a company that should not do a buyback, or if the company has already got too much debt, right? Because if it does a buyback, what's it doing then? It's making its leverage problem even worse. So I can give you a bad news story. A buyback can leave stock value unaffected. It can lower. Give me the good news story for buybacks. So what's the scenario where when you see a buyback, you might actually feel better off as an investor? Well, that's true in general with the cash balance. So that's almost a given. If you have a large cash balance, you're already generating too much in cash. So in a sense, I knew that already when I saw the $60 billion cash balance. Do you remember the loose ends when we talked about, what is the first loose end we talked about how we value cash, right? What does it depend on? Whether we trust management of the company with the cash. And we said if you don't trust the management, what happens? You attach a discount to the cash. If this is probably not going to be true for Google, but if you had a company where you don't trust the management of the cash, when they pay the $45 billion to you, here's what happens. You collect the $45 billion, you put it in your pocket. Let's say you're the only equity investor, but remember, because you didn't trust these guys, that $45 billion was being valued at like $38 billion and $36 billion. So you can see, so when people talk about buybacks as automatic pricing, because you almost see this belief, oh, buybacks always increase stock price. Why? Because there are fewer shares outstanding. If it were that easy, I'd keep buying back shares till I had one share left. It's not that straightforward. For me to assess what the effect of a buyback is, first I need to know what company is doing the buyback. So if you get a chance, the Wall Street Journal had an article about the 30 companies which are, or you can go to Capital IQ and just download the 30 companies that did the most buybacks last year. Take them one at a time and take them through the process. In this company, and it has to be specific to this company, what effect do I think buybacks will have on me as an investor in the company? And you're going to be surprised at the kind of mixed results you get about which companies buybacks are good news at, which companies buybacks are neutral news at, and which companies buybacks are bad news at. So let's move back to the last stretch of the third packet, because I want to talk a little bit about value enhancement today, where I connect all of these decisions companies make to changing value. As I said, while we're doing this, I want to draw a contrast between value enhancement and price enhancement, because if you're a CEO and say, I want to enhance my value as a company, the first question I'm going to ask you, and this is going to be a boring question because you've heard me ask this several times during the course of this class, is do you want to enhance value or do you just want to increase your stock price? And the truth is most CEOs, when they talk about enhancing value, what do they want to do? They want to increase the stock price. Why? Because their options are tied to it, whether they hold a job is tied to it. And the reason I draw that contrast is there are actions you can take as a company that can increase your stock price and have no effect on value. One of the most classic studies of the dot-com boom, a couple of researchers looked at companies in the late 90s that changed their names. You're saying companies change their names all the time. What's the big deal? These companies change their names in a very specific way. They added .com to their names. Okay? So they looked at what happened to the stock price of these companies. Remember, these are exactly the same companies as yesterday. All they've done is taken whatever name they have, .com. No value effect, right? So we can debate cash flows, growth, and risk. This is what happened to the stock price on the announcement of that addition. The stock price increased about 150%. What a waste this class has been. All we could have done 26 sessions is talk about what name should you have for your company, because it looks like it's a much bigger effect than cutting costs and increasing growth. I have to tell you that many of these companies were really small companies, so the 150, but it's still a huge surge in the price. But before you get too excited about just adding things to your name, that was in 98, 99 at the peak of the dot-com boom. And of course the boom bust. And 3 years later the researchers went back and did a second study. And you know what they looked at? Companies that took .com out of their names. Because by 2002, having a .com next to your name was toxic. So when you took .com out of your name, there goes the stock price again. What the market gives you, the market takes away. The problem with price enhancement is you're trying to keep the market happy. You know the problem with trying to keep a market happy? It's like trying to keep a manic depressive happy. It's temporary, and then it passes. And then it's temporary again. So there is moments where you cannot manage a company trying to keep the market happy. And lots of companies try this. They try to keep the company happy by feeding the market whatever it wants. But the problem is the market keeps changing its mind. Today the market likes users. So you're going to boast about users? Be careful. 3 years from now, the market might say, hey, you have lots of users. That's a terrible thing. We've seen what happens to companies that go after users. That's what happens when you do price enhancement. You're basically going to have to constantly change the way you do business depending on what the market likes or dislikes. So let's set price enhancement to the side, even though that's why most companies do things they do. Let's talk about value enhancement. And value enhancement, if you break it down, is very basic. There are only 4 places you can go to increase the value of a company. First, you can try to increase cash flows from existing assets, right? And we'll talk about all the different pathways there. That's your first choice. The second is you can try to increase the value from growth. By doing what? By either growing faster if you're not taking as many projects as you can, or what's the other? Growing slower if you're taking projects you shouldn't be. So both will increase the value of growth. So if you're a company with bad projects and you're growing too much, the way you increase your value is by actually taking less projects. Third, you can try to extend that period before you become a mature company. You're saying on a spreadsheet, that's easy. I just make 5 into 10 and 10 into 20. But with the real business, you know what this translates into? Building up your competitive advantages, your barriers to entry so you can earn more than the cost of capital. Or fourth, you can lower your cost of capital by either changing the mix of debt and equity or matching your debt up to your assets much better. Everything you do as a company has a place in that process. So I'm going to take each of these places and look at the potential for increasing value. Let's say you've been hired as a CEO of a company. Your first stop is, can I generate more cash flows from existing investments, right? So where are you going to start? You're going to look to see whether there's potential for cutting costs. Cutting costs where you feel you've not been efficient before. So cutting costs and more efficient operations. What I heard is higher margins. That's basically what it translates into. So that's your first stop. Second, if you have businesses that are losing money, that you expect to lose money forever, just shut them down. You're saying, why wouldn't somebody already have done it? Because people hate to admit mistakes. If any of you are baseball fans, every time Chris Davis comes up to hit for the Orioles, you got to ask, who signed this guy and why is he still hitting? You have no idea what I'm talking about. Just go look up his numbers. But sometimes you have a big decision made, and it's a bad decision. You hate to admit to it, so it continues. So you know when you see these divestitures? When a new CEO comes in, because the guy says, look, I don't have a problem admitting to the old guy's mistakes. So if you have businesses that are losing money, stop them. What I'm going to say next is going to sound mildly unpatriotic, but I'm going to say it anyway. I don't believe it should be the objective of any company to maximize taxes paid to the government. Maybe you feel different, but I'm going to cover myself fully here before you accuse me of breaking the law. Within the rules, I want to minimize taxes paid to the government. And remember, I don't write the rules, so don't accuse me of doing strange things. So if you write stupid rules, I'm going to essentially take those and I'm going to minimize taxes paid. You know how that's going to show up? The lower the effective tax rate, the greater you have to do. And if you think about how you lower taxes as a company, here are some choices. One is you can pull a Bjorn Borg. Most of you don't remember Bjorn Borg, but in 1976 I was lucky enough to go to Wimbledon, and that was the year where a 17-year-old Swede came out of nowhere, perhaps the most unconventional Wimbledon winner ever, because he had this big loopings. So Wimbledon, you play on grass. Cows eat on it. Basically, the ball just scoots away. But he came out of nowhere. 17-year-old Swede called Bjorn Borg wins Wimbledon. Headline that year, Bjorn Borg wins Wimbledon. Bjorn Borg of Sweden wins Wimbledon. Next year, he comes back and repeats. And the headline says, Bjorn Borg of Monte Carlo wins Wimbledon. So what the hell happened here? Monte Carlo invades Sweden. Is Monte Carlo even a country? It's like a city, I think, crossing line. Maybe some things happen in Northern Europe and you don't notice them. But you know what happened, right? In the mid-70s, Sweden had one of the highest marginal tax rates in the world for individuals. Its tax rate was like 95%. At which point, if you're Bjorn Borg, you're saying, why are you mailing the check to me? Why don't you mail it directly to the Swedish government? So somewhere in 1976, Bjorn Borg started thinking, do I have to be Swedish? ABBA might need to be Swedish, but I don't. I can be Monte Carlo. You're saying, companies can't do this? Remember we talked about the Pfizer-Allergan example? That's exactly what Pfizer was trying to do, is pull a Bjorn Borg, right? But if that sounds too extreme, there's a much simpler way in which you can reduce your effective tax rate. You know what did any of you work in transfer pricing? You know what transfer pricing is? This is entire business, an ecosystem of people who spend their entire lives trying to figure out, because we have a multinational. One division in one country sells stuff to another division. Somebody's got to decide what a fair price is. So when Google US buys stuff from Google Ireland, transfer pricers set the price. You say, what's the big deal? Well, if you set the price high, basically here's what's going to happen. Income will basically move from Google US to Google Ireland. And when you're doing transfer pricing, that's exactly what happens. Income from a high tax. Of course, the tax guys know it, so this whole thing is an extraordinary benefit for lawyers because the IRS sues and you counter-sue and you counter-sue, and by the time this is all said and done, what you've effectively done as a multinational is ended up with an effective tax rate closer to the lower tax rate locales within your operations. But effectively, you're devising the same thing. I'm not a great fan of risk management. For the most part, I think companies manage risk too much because they should just let it pass through. But there's one potential tax benefit that comes out of risk management, which is you smooth out your income. And especially if you have tax rates that spike at very high levels. For instance, in the early 80s in the US, oil companies were hit with a supernormal profit tax because they made so much money. So if your tax rate exceeded $5 billion, you had to pay like an extra 10%. What oil companies started doing was using risk management, hedging, to keep their income below that threshold. The end game here is you want to pay less in taxes increases value. As we go through this process, you're going to see every entity within a company essentially have a role in value creation. That's a tax lawyer's guy, creating value by lowering your effective tax rate. If you've overinvested in the past, live off the fat. So don't do this CapEx, act like no company is required to build more capacity every year. If you're at 300% of capacity already, you're over capacity, live off the fat. And what that means is you can continue to depreciate that asset, but you don't have to put CapEx in. The way this shows up in your DCF is you get the depreciation for the next 5 years. You can stop your CapEx because in a sense you're writing off past overinvestment. You increase your cash flows. And finally, if you're a company that uses a lot of working capital, retail for instance, managing your working capital better can do wonders for your cash flows. When I took my first accounting class, I was told that healthy companies have current ratios of 2. You know what a current ratio is? Current assets divided by current liabilities. It's an absurdly stupid rule of thumb. But that's what we're all taught. If your current ratio is less than 2, you're not a healthy company. Current ratio greater than 2, you're a healthy company. Until Walmart came along and said, that's pretty stupid. If our current assets are greater than our current, if they're double, basically our working capital needs are huge. And as a retailer, we're losing $2 billion because our inventory needs and accounts receivable are twice our accounts payable. And one of the innovations that Walmart brought to the retailing business was much more just-in-time inventory, which is basically we're not going to pile our shelves up with stuff and lock up cash. And if you think about how much cash they generate, we're talking billions of dollars each year in additional cash flows. So if you're a company that's working capital dependent, so essentially these are all things you do. Why? Because you want to get more cash flows from existing assets. If you're hired as a CEO for a mature company, this is where you go for value enhancement, right? Because this is where the bulk of your value creation comes in. So that's your first stop. Are there ways I can increase my after-tax cash flows from existing investments? Any questions on that? Your second stop is, hey, can I increase my value of growth? And here, thinking about growth as coming from what you reinvest and what your return on capital is, gives you a handle on how you can increase the value from growth. If you think of the growth rate as reinvestment rate times return on capital, there are 2 ways you can increase growth. One is you can reinvest more by either taking more projects or doing acquisitions, or you can reinvest better by pushing up your return on capital, or do both. So when you're a company that has a 20% return on capital and you're reinvesting only 10% every year, it's worth asking the question, couldn't you reinvest more and accept a lower return on capital? A lower return on capital, if it's higher than the cost of capital, still creates value. So your first stop is, can I reinvest more? The second stop is, can I earn a higher return on capital? And I'm going to decompose return on capital. It's very trivial decomposition, but it's a useful one. You can actually write the return on capital as operating margin that number that we, remember the three inputs I asked you in valuation? What's your sales growth? What's your operating margin? What's your sales to capital ratio? Operating margin times sales to capital ratio is your return on capital. So that product is what your return on capital is. So if you want to increase your return on capital, you can either try to push up your margin by pushing up prices, or you can try to sell more. Okay? Sometimes you might accept a lower margin, but because it comes with much more turnover then, you might actually end up with a higher return on capital. In fact, I'm not a marketing person, but price leader, volume leader strategies. Volume leader basically go for low margins and high turnover ratios. A price leader go for high margins, and of course you'd like high on both. But sometimes you might have to accept trade-offs. So when you think about growth, again, just don't think about higher growth. Higher growth by itself is not going to create value. That higher growth has to come with excess returns. So when you walk into a firm, let's suppose that there is not much potential from cash flows from existing assets. They're pretty efficient. You turn to growth and say, what can I do to increase the value of growth? And there are lots of different strategies, right? You can do acquisitions, you can take projects, you can come up with new products, you can do R&D. So it'll be interesting. It's interesting to see which of these different approaches historically has had the best chance of success. And some of the best pragmatic research and valuation gets done by McKinsey in their McKinsey Quarterly. So McKinsey Quarterly actually took their client database, and they have a very rich client database because pretty much half of the S&P 500 at some point in time are McKinsey clients. So they have 40 years of what their clients have attempted, and they looked across these 40 years at which type of growth strategies had the greatest chance of paying off in terms of value creation, and they ranked them from best to worst. So let's start at the top. At least based on the research, the very best way to grow is to come up with a new product. Okay, so if you look at Apple's rise from 6 billion in 2000 to 400 billion by the time it got to 2010, it came from the iPod, the iPhone, the iPad, new product, new. Of course, the problem is this is a strategy that might have the highest. So the way to read this is $1 million invested in that strategy creates between $1.75 and $2 million in additional value. It's a very lucrative strategy, but it's a very skewed strategy, which means if you're a winner, you're a big-time winner like Apple, but there are a lot of people who try new products where it'll fall to the wayside. So it's a big payoff, big chance of failure strategy, but it's the number one. Right below it is expanding an existing market, either geographically, where you push into countries that you didn't used to be in. Remember, in the early 1980s, Coca-Cola was primarily a U.S. company. Much of their growth in the next 20 years came from going emerging markets. And so you can go geographically. The other is to find new uses for your product. I mean, you have Bayer aspirin, you got that second win when people found that taking that, and now they've, of course, taken that back, that taking an aspirin every day reduces your. So when you think about second uses or second markets, you're expanding an existing market. The third is maintaining or growing your market share in a growing market. It's nice to be in a market which is itself growing. This was the benefit that Apple and Samsung got over much of the last 10 years because the smartphone market was growing so much that Apple's market share could get lower, but they could still grow because the market itself was growing. So those three strategies historically have had pretty good track records. And then you get to the bottom of the barrel. Competing for share in a stable market. Historically, you had a pretty large chance of failing when you invest money, and the payoff is not that good. How come? What is competing for share in a stable market required to do? If you want a higher market share in a stable market, what do you often have to do? You've got to cut prices. You get the higher market share, but you get lower margins, lower returns on capital. The net effect, even though you get growth, might be lower value. And then at the very bottom of the barrel, and this shouldn't surprise you after last session, is acquisitions. If you as a company tell me you're growing through acquisitions, my view is you're already scraping the bottom of the barrel. I should probably be getting out of your company rather than getting in, because historically it's been the worst way to grow. And last session we talked about why that might be. So when you think about growth strategies, again, think like a CEO. You've been hired in a company. There are going to be a lot of people who say, let's go for more growth. You've got to slow the process down because more growth by itself is not going to create value. It's more growth with excess returns. And in fact, if you look at the numbers across the world, there is a reason you should be cautious for going for more growth. This is actually a breakdown at the start of 2019 of what percentage of companies earn less than their cost of capital and how much. And I've talked about this before in the class. the number of value destroyers vastly outnumber the number of value creators. So if you're in that value destroying group, I want you to grow less, not more, because that growing more is just going to destroy my value. So that's the second stop. Look to see whether you can increase the value of growth, either by growing more if you have lots of projects you're leaving on the wayside, or by growing less if you're taking projects you shouldn't be taking. The third stop is, can I do something to increase my competitive advantage, my barriers to entry? So I'm going to talk some strategy, and this is going to be unnatural for me, but I'm going to try. If you think about competitive barriers to entry, let's start thinking about some classic barriers to entry. First, of course, is brand name. Right? What does brand name allow you to do? It allows you to charge a higher price for the same product. We valued brand name at Coca-Cola. 85% of its value came from brand name. When I valued Levi Strauss, a big chunk of its value came from brand name. So if you have a brand name, take advantage of it. And don't let it slip away. There have been great brand names that have essentially almost disappeared. Quaker Oats, a historic brand name, essentially allowed to kind of dissipate before people rediscovered it. So when you think about brand name, you think of it as permanent, but brand names can dissipate over time. And one of the challenges I think big brand name companies around the world face right now is those brand names come from a different age. Maybe if you're over the age of 50. In fact, when I talked about Levi Strauss, one of the things I was accused of was being old. And I said, yeah, that's true. I can't do much about it. It's part of the way time works, right? As time passes, you get older. But the point they were making is, in fact, one of the responses I got is nobody under the age of 40 wears Levi's. So maybe that's true. Okay? Maybe I'm attaching a brand name value because I'm thinking about a different age, but that's something that brand name companies around the world are facing. But if you have a brand name, whatever it is, take. If you can build a brand name, then clearly that's going to have value. And that's not easy to do, right? Because how do you build a brand name? You can spend more on advertising. If that were the answer, AT&T would have a very valuable brand name, right? But how many of you are willing to pay a price premium for AT&T? I want a price discount. I have AT&T. It's got nothing to do with I shouldn't say nothing to do, but it's got less to do with how much you spend and more to do with being in the right place at the right time. Right? There's some movie star where social media. So who knows how brand names develop? It's almost magical, but if you have it, don't let it go. The second is to get protection against competition. It's always nice to have. Okay? Well, of course, the classic manifestation of this is that pharmaceutical companies, what's that legal protection called? It's patents that are enforced, so basic. To the degree that you can get protection against competition, it does help you because it means you can keep the competition on. In fact, when I valued Severstal, the Russian steel company, one of the things they did was actually shrank in size between 2007 and 2016. They became half the size, which you're saying that's terrible. But what they effectively did is they abandoned many of their operations in the rest of the world, went back to Russia. And in Russia, their margins are close to 20%, which is unheard of in this business, right? Typical steel company margins like 4 or 5%, they're 20% margins. And the reason the margins are so high in Russia is competition is essentially non-existent. Either because at that time there were sanctions, no non-Russian steel company was. So if you can get protection from competition, that does increase your value. Third potential competitive advantage is if you can create switching costs, which are large, it helps you. You know what switching costs are? You want to make the cost of switching into your product as low as possible. But once people switch in, you want to make the cost of switching out as high. It's the exact opposite of the Uber and Lyft problem. Uber and Lyft has no stickiness. This is you create stickiness because once people get into your product, they're kind of stuck with it. And this is actually at the core of many technology companies' competitive advantages, is you create stickiness, switching costs. Okay? I think about the original Office advantage, right? Office, when it first came out and you looked at Word and PowerPoint, there were a lot of competing companies. I remember other, presentation software and some of them were better. On each individual item, I would look at Word versus something else. Maybe I should try Word Perfect. Or I'd look at, PowerPoint, maybe I should try somebody else. But the problem that I had was the longer I stayed with Office, the more stuck I am with Office because I have this history of files I've created with PowerPoint and Word that if I decide to switch now, God only knows how they'll get converted. And if you're clever as Microsoft, you want to make that conversion as painful and difficult. Look at how Microsoft makes my life difficult. When I go from a PC to a Mac, it made my betas into bikes and my sigmas into, I forget now what it was. But basically, and I understand. It pisses me off, but you want to make switching costs as high as possible. And finally, if you have cost advantages as a company, that's a clear competitive advantage. If Aramco ever figures out a way to go public, it's going to come in with a tremendous advantage, which is it costs only $7 or $8 a barrel to extract oil in Saudi Arabia. It might cost $30, $50, $75 in the rest of the world. And that cost advantage can be used in one of two ways. Either you can set prices lower than your competition and sell a lot more, or you set the same price as everybody else and make a lot more, right? And if you're an oil company, you don't want to go with the first one because then you exhaust the oil under the ground. But having that cost advantage can give you a leg up. When the Templeton funds were among the first mutual funds to go into Asia in the 1980s, when it wasn't fashionable. So when Asia became hot, Templeton funds were able to take advantage. It didn't last long, though. Those cost advantages are not permanent in some businesses, but to the degree that you have a cost advantage, you can take advantage of it. So that's my third stop. Is there a way I can build more competitive advantage? And finally, if there is a way you can lower your cost of capital, you're going to take it. Of course, the classic, is change the mix of debt and equity, and that's true. In corporate finance, we talk about the right mix of debt and equity, the optimal debt ratio for a company. But that's only one of four ways. Here are the other three. If you've mismatched your debt to your assets, get rid of the mismatch. It's raising your cost of debt and raising your cost of capital. But there are two others that are kind of subtle ways in which you can lower your cost of capital. They go back to what we talked about in the context of betas. Remember I said the beta of your company, I'm talking about the beta of the business you're in, is driven by how discretionary your product or service is. If you can make your product or service less discretionary, if you can convince me that I cannot live without your product, what have you effectively done? You've lowered your beta as a company. So if I can somehow change my characteristics of my products that you cannot live without my product, I've effectively lowered beta, lowered cost of equity, lowered cost of capital. And we also talked about operating leverage, right? Operating leverage is a fixed cost structure. To the degree that you can make your fixed cost into variable cost, have a more flexible cost structure, I'm going to reward you with a lower beta, a lower cost of equity, and a lower cost of capital. Too many people, when they're asked to change the cost of capital, just look at the mix and then they give up. But don't stop there. Look at the type of debt, see if it's mismatched. And then look at both the products and service the company has and their fixed cost structure, because there might be other things you can do for the company that lower their cost of capital. Increase cash flows, extract more value from growth, extend the life of your growth period by building competitive advantages, lower your cost of capital. Everything you do in restructuring has to be somewhere in there, right? You can take the most elaborate restructuring in the world, and if it's structured right, you can say, this is what I think will change, because it sounds like I'm kind of focusing in on things that affect value, but I have to, right? It has to show up somewhere there, because if it doesn't, I'm going to come back and say, that was a nice, very elaborate action you took, but I see nothing changing. Your value doesn't change. So now let's apply this. I'm going to throw a few companies at you, and you're going to be CEOs, these companies, and tell me what you change about the company. So it's going to be I'm going to give you a surface level valuation. SAP, German software company. Valuation that I did in 2005. So I'll present the valuation, and what I want you to look for are weak spots, places where you think you can come in and change the company. So in 2005, S&P was earning a margin a little bit above the industry average, so file that away, so they're not some badly managed company. They were reinvesting a fair amount, 57%, not bad for the company their size, earning a very good return on capital, 19.9%, and growing about 11.44% a year. Just as an aside though, in 2005, S&P was still heavily focused in Europe and the US. They had a very small presence in Asia. So maybe that's something you'll fix. So they're a company that's delivering high margins, high returns on capital, reinvesting in a fairly healthy way, growing at a good rate. Their debt ratio is about 99% equity, 1% debt. So they're almost entirely equity funded, reflecting their history. They're a technology company. They've always hated debt, so they're predominantly equity funded. And the cost of capital they have is about 8.68%. So basically, I've given you the characteristics of their growth. The cash flows are growing well. I put in a growth period. I come up with a value per share of 106 euros per share. That is reflecting SAP managed as is. So let's say you walk in to the CEO's office at SAP and you're looking for, how do I increase the value of the company? What's the first obvious place you're going to look? What seems to be the weakest link? It looks like they have too much equity and too little debt, right? But you say, well, should I go to 10%, 20%? The only way to answer that is to compute what your cost of capital will be at different debt ratios. So basically, I took SAP, I broke down their debt ratios, and it turns out that the cost of capital is minimized around 30% debt. Now, don't do anything rash and jump out there already, but clearly there is potential for the company to borrow more money. The second is, when I talked about reinvestment, I talked about the fact that they are predominantly invest in Europe and the US. They don't seem to have much of an Asia exposure. So maybe I can grow there. And that comes with consequences, right? If you grow more in Asia, that's going to increase your growth rate, but it's probably also going to increase your cost of capital because you're going to be exposed to more risky countries. There are no free lunches here. You can't just increase the numbers you like and leave everything else untouched. So here's what I did. I made two fixes, and they're not big. I reinvested more in emerging markets, which pushes up their reinvestment rate and their growth rate. And I left the return on capital as is, but even the return on capital, you could argue maybe it'll be different because those markets might be more lucrative, but I've left it as, so my growth rate is higher. The second is I moved the debt ratio to the 70-30 mix that I had before, lowers the cost of capital. The value that I get for SAP with those two changes made is about 126 euros per share. That's changing. And doesn't seem like much of a change, but the company is pretty well managed. In fact, if I make SAP closer to being optimally managed, you can see this difference is going to narrow. It's very similar. We talked about control premiums and acquisitions. SAP is not a classic company you're going to target for a hostile acquisition to fix things because there's not much to fix. Let me give you a contrast. This is my valuation of Blockbuster that I did well after its glory days, like 2005. But they were still around, and they were still opening stores. This was a company that seemed to think that people were actually, it was almost like they were on autopilot. Let's open 40 stores. Why? Because that's what we've always done. And I actually picked Blockbuster because they'd just been targeted by Carl Icahn at the time that I did this valuation. So first, I did a status quo valuation, assuming what they would, and here's what they were doing. They had, their margins had dropped over time, but they were still making money. They were reinvesting about 26% by opening new stores and earning a 4% return on capital while they were doing that. And their cost of capital was not bad, but it's higher than 4%. It's 6.17. They're growing, but they're growing by opening stores that are essentially earning less than the cost of capital. They're about 50% debt, 50% equity. I considered looking at the financing mix, but there's probably, they probably have a little too much debt. But the real problem here is in their investing, and if you can fix that, you could potentially increase the value. So what do they need to fix? They need to make sure they don't take bad projects. In fact, I'm not going to ask them to do miracles. There might be no good projects, but would it be too much to ask them to take zero net present value projects? I think that's, in fact, to take zero net present value projects, you can do nothing, right? So basically, you can say, look, if I can't find stores open, why don't you make a reinvestment rate zero? Because that's going to give you a higher value. In fact, with that change, just making the cost of capital, I come up with a value of $12.47. Compare that, $5.13, $12.47, by just fixing the problem of investing in a business where you shouldn't be investing. It's amazing when you see these especially mature companies that are trying too hard. You know what I mean by trying too hard? They want to grow, so they keep taking and throwing more money in. All you need to do is turn off the machine, stop reinvesting, and you can stop destroying value. Because you don't even have to do anything in affirmative. Just stop doing the things that hurt you, and the effect on value is going to be dramatic. Yes?
But is that true for young companies like Uber or?
Probably not. If they stopped investing now, Uber is worth what? Probably it's worth minus 50 billion, all the money they threw. So it's Uber, we haven't decided that they're taking bad investment. We just don't know whether there's a business model that can convert the growth into good money. So Uber's problems are a very different one. They've got to figure out a way to take this growth. They've conquered that half of the equation and convert it into margins and returns on capital. So they're telling Uber to stop investing now would just basically mean shut the door, right? There's no existing cash flows. There's no value created right now. And if that's what you decide, there's no business model that's going to deliver profits, that's what you might ask them to do, shut it down. You're not going to create value, but at least you're going to stop the cash flows going down the drain. The Uber and Lyft drivers chose a particularly appropriate time to walk off their jobs, right? The IPO is tomorrow, and I think they have maximum leverage today. So let's see how that plays out now. So let's bring what we've talked about into the value control. So value control comes from looking at the firm run optimally, with quotes around the word optimally, because that's a subjective judgment, versus the value of the firm run status quo. That difference is the value of control. The expected value of control is that difference times the probability that you can actually change the way a company is run. Right? What affects that probability? You look at a company, it's badly managed and badly run. Let's say it's Baidu. Baidu's badly managed, badly run. You can come up with a difference between optimal value and status quo value. But then what's the brick wall you're going to run into? How do you change the management of a company where you have absolutely no corporate governance power? So one of the things I'm going to look at are what market you're trading in, what are the restrictions and takeovers, because one of the ways I can create change is through takeovers. Do you have voting shares and non-voting shares? That already makes it, so if I don't like the way Levi Strauss is run, I can compute a big value for control, but because you're voting and non-voting shares in Levi Strauss, I'm going to end up saying, look, there's nothing I can do. I'm going to look at access to capital, because to change management, I might need to raise billions, and if I'm in a market where that's tough to do, that's going to affect me. And I'm also going to look at the size of the company. So if I don't like the way Facebook is run, the odds are there's nothing I can do about it. Not only because you have a control, the fact that Mark Zuckerberg owns the voting shares, but because you have a $700, $800 billion company. So when you look at the probability of management change, you're looking at something that is going to be different across companies and probably different across time. 20 years ago, changing management at a European company was close to impossible. It was just not done. It was not done to the point that if you tried to do a hostile acquisition of a European company, banks would not lend you money. So can you imagine trying to do a hostile acquisition of Fiat, and you go to an Italian bank and say, would you lend money to me to... Even if Fiat was the worst managed company in the world, that would be the end. What broke the process down in Europe, and Telecom Italia was the first time this happened, was the opening of European bond markets. As long as banks were the only way you could borrow money, Europe was off limits for change. The probability of change was low, which means that the expected value of control for a European company, even if it were badly managed, was zero, because the probability of change happening was zero. So every time corporate governance rules start to shift, the probability is going to start to shift. So if you have a country where a new set of corporate governance rules have come in, which can give stockholders more power, you almost instantaneously have increased the probability of change in that across all companies, and the expected value control. The second is, and I've talked about this multiple times, you might not like Carl Icahn, and he definitely doesn't even think about you. Okay? But the reality is you should all be, as stockholders, we should all be grateful that the Carl Icahns and the Bill Ackmans are around. Why? Because you and I can get as pissed off as we want about a company, but there's not a whole lot we can do other than raise our blood pressure. You need shit disturbers. That's basically what Carl Icahn and Bill Ackman bring to the process. They stir the pot. They push for change, and without them, it's not going to come. And in many markets where there are no activist investors, all you have to do is see what happens when you take them out of the process. And you very quickly see that these companies will stay badly managed. And finally, it's amazing what one hostile acquisition will do in terms of focusing the attention of managers. And often you'll see this at a sector-wide basis. You see one steel company taken over in a hostile acquisition. All of a sudden, the CEOs of every other steel company wake up and say, oh my God, what can we do to enhance value? That focus that comes from knowing that an imminent execution is coming to your company kind of gives you the incentive to change things. So there actually have been papers that have tried to estimate the probability of change. And actually they're interesting. Okay? Here's how these papers work. Is they take the last 20 years of data. They look at companies that have been taken over in hostile takeovers, and they look at the rest of the market. You have to look at everybody. You can't just look at the companies taken over. And then they attach a value of 0 to companies that were not taken over and a value of 1 to the companies that were taken over. So make that your dependent variable. 0 or 1, that's all you have in your dependent variable. And then in the independent variables, they throw in things that can affect whether you'll be taken over. How much debt you have, how badly managed you are. So it's like a regression, but the only difference is instead of looking at PE ratios or something, you're looking at 0 or 1. You're saying, what's the output of that regression going to tell me? First, it's going to tell you what variables are statistically significant in explaining which companies get taken over. But here's the more interesting thing, is once you run this, it's called a probit. It looks like a regression equation. You start plugging in numbers for your company, you will get an expected probability for your company based on its characteristics. You can say, given the history of hostile takeovers in the US, you as a company with a low debt ratio, terrible return on capital, horrible stock price, and lots of cash, have a 37% chance of being taken over. And that's essentially a way in which you can, I'm not suggesting you have to do this for your company, but start thinking at least about why some companies are more likely to see this, probably be a high number than a low number. And that's what makes me depressed about watching all this new set of companies come out with voting and non-voting shares. Because my guess is you throw that in as an independent variable, whether you're voting or non-voting shares, that's going to have a very strong statistical significance as to whether you ever see a hostile takeover. It might very well rule out any hostile takeovers. So it gives you a way of bringing in those qualitative variables into a number. So I'm going to give you 4 places where this expected value of control comes into play. And you're going to see that value of control is embedded in almost everything we do. The first, of course, so we're going to start with hostile acquisitions. Essence of a hostile acquisition is you're taking over a company to change the way it's run. It's driven entirely by control value, by what you think it can handle. Second, I'm going to argue that even if you're not in a hostile acquisition, when you value a publicly traded company, that value should actually be a weighted average of 2 numbers. Don't worry, I'm not going to ask you to do a second DCF. The DCF you did, I'm not sure what it was, but let's say the DCF was a status quo DCF. You valued your company as a status quo DCF. If you really want to get an expected value for your company, you should probably revalue the company with change coming to the company. And your expected value will then be a weighted average, weighted by the probabilities of each scenario. We did this with Hormel Foods, right? An expected value. And if you're voting and non-voting shares, this becomes the vehicle I'm going to use to decide how much of a premium I'll pay for voting shares over non-voting shares. And finally, in private company valuation, there is this phenomenon known as a minority discount. And here's what the minority discount looks like. If you buy 51% of a private business, you will pay a lot more than if you get 49% of that same private business. That 2% difference makes a huge difference. Why? Because with 51%, you get to run the private company. 49%, you essentially are a minority owner. And I'm going to use the expected value of control to quantify how much the difference is going to be. So let's start with hostile acquisition. So let's take Blockbuster since we've already estimated the numbers. The value that I got with my status quo was $5 and something, and the optimal value I got was $12.47. Stock was actually trading at $9.50 per share, somewhere in the middle there. So you're a potential hostile acquirer of Blockbuster. Here's my first question. $12.47 is the value you come up with the changes you plan. And we've kind of answered it when we did acquisition valuation. Should you pay the entire $297 as a premium? And if you do, then you're doing all the hard work. So the first thing when you do a hostile acquisition is you're trying to figure out how much below $12.47 can I pay, because you want to keep some of this increase in value for yourself. Okay? But let's make this a little more interesting. Let's just take that market price of $9.50. It's between my 2 numbers, right? And this assumes that my 2 numbers are in fact reasonable estimates of status quo and optimal value. Implicit in the 950 is a probability of change, right? So I can solve for that, and that probability is about 59. That's a break-even. With that 59.5% probability, the market price I see puts me between my status quo and optimal value. Of course, it's built on the presumption that those 2 numbers are right. The day ICANN announced that he had taken a position in the stock price jumped. In fact, if I'd looked at the probability before he showed up, the probability before he showed up was about 42%. So when I think the stock was like $8 per share. So when he came in, the stock jumped. And often when activist investors tell you they've taken a position in a stock, you'd see the stock price jump. Right? It's a standard response. And you say, what changed here? It's the same company. What's changed is not the values per se, but the probability of change just went up. And if you have a badly managed, badly run company, that change can be a pretty dramatic one. So if you have a badly managed, badly run company, you don't even have to be right on value. All you have to be right on is whether an activist investor will show up. It's a different way of investing, where you don't even try to get a sense of is this my price? You're trying to get a sense of what is the likelihood of a catalyst in this company that will cause the change in this company. And I'm going to use that as a way of thinking about the value of any publicly traded company. If you have only one class of shares, I'm going to argue that what you observe as the price out there, even if the market is sufficient, is a weighted average of your status quo value and your optimal value, weighted by whatever the market attaches as probability. So if you live in a market where corporate governance is dead, no management ever gets changed, then stocks are going to trade at status quo value. If you live in a market where there's change likely, you're going to see an expected value. So even if you're an investor in a company with one class of shares, you should care about the value of control. It drives your value. But if you have two classes of shares, then there's a really interesting divide that occurs. If you have a non-voting shares, what are you stuck with? The status quo, nothing you can do. And I'm going to take an extreme version of this model because it's a free rider problem we'll come back and talk about. But if you lived in a world where with the non-voting shares you're stuck with the status quo value, here's what I'm going to do. I'm going to take my status quo value, divide by the total number of shares, and say if you're a non-voting shareholder, that's going to be your value per share. The essence of owning one of the voting shares is you now have a say in whether the company can change, right? So I'm going to take the value of control, which is basically optimum minus the status quo value. I have to attach a probability that that will actually happen, but I'm going to take that expected value of control and divide it only by the voting shares, arguing that the expected value of control accrues only to those voting shareholders. So what that's going to do is create a premium for voting shares, right? How much that premium will be will depend on what? Two things. How badly managed the company is. So if you have a perfectly managed, perfectly run company, voting shares and non-voting shares will pretty much trade at the same price. The worse managed a company is, the bigger the difference is going to be. And the second is, what's the likelihood of change in the company? If the likelihood of change in this company goes to zero, voting and non-voting shares in this company will trade at roughly the same price. Facebook has voting and non-voting shares. Given what I just said, if the voting shares trade, what should the price in those shares be? Roughly the non-voting share price. Why? What's the probability of change at Facebook? Given the voting structure at Facebook, the probability of change coming is close to zero. So in companies where the chance of change, so in a sense with voting and non-voting shares, one of the problems is unless the voting shares start to get dispersed, which they sometimes do. For instance, this happened, Viacom. At some point in time, the shares started to get dispersed. You'll actually not see the voting shares trade at a premium, and it's not because investors are being irrational. They're just being realistic. They're saying, hey, what's change doing for me? The problem is you're going to be stuck at the status quo value, right? Because you're never going to see the change to the optimal because you've essentially ruled out the chance of change. So when you look at voting and non-voting shares, whether you see a premium will depend on both those components. In fact, I'll give you an example. So I valued Embraer, which is a Brazilian aerospace company. The status quo value I got was 12.5 billion reais. The optimal value was about 14.7 billion reais. So there's a $2.2 billion additional value that's being left on the table. The company had 243 million voting shares and 477 million non-voting shares. So my end game was I wanted to estimate what the value of a non-voting share is and what the value would be to a voting share. So here's what I did. I took the status quo value, which is 12,500, divided by the total number of shares, voting and non-voting shares. I got a value of 17.38. So that's my value for a non-voting share. And then you're stuck with the status quo. Then I took the change in value, 2.2 billion. The probability of change here is pretty low. Why? Because the Brazilian government does have some influence in change here. They throw their weight behind it. It's not zero. It's not like Facebook. But the chance is low, so there's a 20% chance of change. I took the 20% chance times the 2.2 billion, and then I divided that only by the voting shares, the 242.5 million voting shares. The value per share that I got for the voting shares was 19.19, about 10% higher than my non-voting shares. But the Brazilian government tomorrow passes a law that says no Brazilian national interest company can ever be taken over or changed without our assent. They put in, what will happen to the 20%? It will drop to 0, and very quickly you're going to see the premiums and voting shares start to disappear. Okay. Yes?
Would you apply this approach to publicly traded companies that are majority owned?
It's a problem. I think if is it one class of shares or two classes of shares? One class of shares, if it's majority owned. Let's take the New York Knicks, not publicly traded. Let's take them as a business. Well run or badly run? This is the most horrifically run sports franchise in history. I mean, the reason I say that, if you look at the New York Knicks, they're actually the most valuable NBA franchise. Absurd if you think about their track record for the last 10 years, right? I mean, have they even been to the playoffs any time in the last 10 years? Yeah, they've like fallen out of contention like the second day of the season or the third day of the season. But it's an incredibly valuable, but it's run by James Dolan. He got it as, I guess his father said, you want something to do, here, run the Knicks. Right? Because he was so damaging, I guess, in the rest of the business, and wanted him away from the rest of the business. Majority owned. Right? There's no, if you look at the value that I'd attach to the Knicks, with him in control, I have to value them run as is. There is no optimal value because change will never come. So if you have a majority controlled publicly traded company, there's only one value, status quo value. Unless that majority owner is 70, 75, 80, there is mortality here that might work in your favor, right? It's a majority ownership, shares go to somebody else. So there is always that chance, but the more you get that complete control, the more you're stuck with the status quo value, and the bigger the penalty you pay, the worse run the company becomes. So if it's perfectly run, you might not care. Right? And that, I think, is the cautionary note I would introduce, because many people, you ask them, how come you trust, Sergey Brin and Larry Page to run Google? How come you gave them this dictatorship power? And why do you do their response is, but they're good managers. It's the same argument you have about benevolent dictatorships versus malevolent. I mean, they're dictators, but they're Lee Kuan Yew kind of dictators. They do it for the best interest of the company. The problem is benevolent dictators become malevolent ones, and that's when you start to pay the penalty for giving up absolute control. Yes?
Could you explain one more time why you divide only by the voting share?
Okay, my argument is control is coming out of the voting share part. And this is where the free rider problem comes in, which is if you change the overall company, everybody benefits. But the way this usually shows up is if you have a two-tier takeover. And I'll give you a personal example where I paid the price for this. When InBev got bought by InBev, which is the Belgian brewer, I was actually a stockholder in InBev. So I wake up, I look at the newspaper, it says hostile takeover, not even a hostile, friendly takeover of InBev by InBev. And I expected my stock price to go up. It's a takeover. My stock price barely changed. They said, what the hell happened? So I started digging. It turned out that InBev, when it bought InBev, bought only the voting shares. They paid a huge premium, 100% premium for the voting shares. They essentially paid, because once you got the voting shares, you had control of the company. They paid me nothing. So when you have two-tier takeovers, this is very clearly what happens. The voting shareholders will negotiate this huge premium. The rest of us have to go along. In some countries, they have restrictions on this, where you basically have to protect the non-voting shareholders. So that's the extreme scenario. If change comes to the company itself, then you get more of a sharing of the benefits. So this is think of it as the most extreme scenario. Voting shareholders get the expected value of control fully, but the more sharing there is, the smaller the difference will become, but it'll never become quite zero. And finally, let's talk about minority discounts. As I said, minority discounts reflect the fact that you don't control the company. And here's the simplest way to quantify the minority discount. Let's suppose you have a company, it's a private candy company, Kristen Candy. You valued the equity at 1.6 million. Right? That's if the existing management continues to run the company. But you think if this company were better run, the value should be 2 million. So 1.6 million versus 2 million. I offer you 49% of this company. What's the most you're going to be willing to pay? 49% of 1.6 million because the status quo still runs the company. I offer you 51%. You're willing to pay up to 51% of 2 million because you now control the company. That 2% difference translates into almost a 25% difference in value. And the worse run the private company is, the more this minority discount is going to be, right? So this is again why, many private company appraisers put this discount, it's 20%, 25%. You can't put an arbitrary discount until you tell me how the company is run. So when you think about the expected value control, it's going to show up in lots of different ways. So if I ask you to enhance the value of your company, I'm not going to ask you to do that. At one point in time, the project required that as the last piece of the project. But then I realized it happens in the last week of class and you already have enough to get done in the project. But if I asked you to do it, you could, all you have to do is go to the spreadsheet and do what? Look at industry average margins, say my company's margins are lower, or look at the debt ratio and say I could use a higher debt ratio. Or look at the growth and say I'm growing at returns and earning less than the cost. And fix them and you come up with an optimal value, right? So if you get a chance, try it out. It doesn't have to be for this project, but it can be for any other company. Coming up with this optimal value. Value enhancement fundamentally requires you to go back to basics. Having said that though, consulting, the cream of consulting now, whether it's McKinsey or Bain, has become value consulting, which is basically rather than do the low-level consulting of going and fixing processes, consultants go to companies and tell them how they can enhance value. And the problem is if they did what we just did, people are going to say, well, that's pretty obvious. Why would I pay you millions of dollars for telling me the obvious? Increase cash flows, increase growth rates. So consulting firms over time have tried to develop proprietary acronyms that they claim are better at enhancing value. Stern Stewart in the 1990s came out of nowhere, created this entity called EVA. Sounds fancy, but after I just tell you exactly what it is, you can say, really? That's what they charge money for? Holt Associates created called CFROI. Deutsche Bank created something called CROCI. I said, you can't come up with a better name at least. It was cash return on capital invested, but CROCI just sounds like a strange thing. But basically their view is this is a magic bullet. You don't have to worry about all this DCF stuff. We'll give you this metric and all you have to do is focus on this metric and everything is going to be good. So I'm going to start with the basic. So the advantage of this is you're now replacing an elaborate DCF with all these different levers with one number. So if you're the CEO saying this is great, all I have to do is one number, just watch it every day. The disadvantage is any time you replace that complexity with one number, there are going to be trade-offs. So I'll use EVA, I'll pick on EVA, but I could do this with any of these acronyms out there. So I'll give you the definition of EVA. EVA is return on capital minus cost of capital. So let's start with the first major insight out of EVA, which is you should make more than your cost of capital. That's a good thing. It's okay, that's deep insight. And if you can make it on a big project, it's even better than on a small project. So basically they take their excess return and multiply by capital invested. So if you can earn more than your cost of capital and you can do it on a larger scale, you're going to be a more successful company. This deep insight or set of deep insights was so unexpected that at one point in time, half of the S&P 500 companies had paid Stern Stewart to come in and sell them EVA. It was actually, I should put a little R next to the EVA, it's actually a registered trademark. They found this incredibly new device, return on capital, because by multiplying, I guess they've come up with a new concoction. And their argument, what Stern Stewart's argument was, this will give you better discounted cash flow valuation if you base it on EVA. I'm going to show it's a lie by doing a very simple EVA valuation and comparing it to a classic DCF valuation. So let's take so when you look at this, and you're going to see this play out, the value of a firm is a function of its cash flows, growth, and risk. There are ways I can slice the cash flows, and that's what EVA does, that gives you a different pathway to get to the same value. You can't create value by just slicing numbers differently or giving an acronym. So here's the example I'm going to use. Let's suppose you have a firm that has a book value of capital, invested capital of 100 million. It's earning a return on capital of 15% and has a cost of capital of 10%. Let me pause right there. So they're earning a 5% excess return on a $100 million capital invested. So each year they're creating $5 million in excess value. The firm is expected to make additional investments of $10 million every year for the next, so that $10 million is like new CapEx. And on the new CapEx, I'm going to tell you that they're going to continue to make 5% more than the cost of capital. So not only do they have existing projects making more than the cost of capital, they have these new projects that continue to add to it. After year 5, there'll be 5% growth in perpetuity, but after year 5, any new projects you take, you earn just your cost of capital. So I'm going to actually first value this company using an EVA approach, and it's going to sound fancy, and you're going to get there, and then I'm going to do a DCF valuation of the company, and let's see if in fact EVA gives us a more focused value, a better value. So here's what I did to value the company with an EVA. I started with the capital invested, that's my base. I took the present value of just the excess value created. So basically I'm taking the $5 million in additional value. If I make that every year in perpetuity, that's an extra $50 million. 100 plus 50, 150 million is the value of my existing assets because they make 5% more than the cost of capital. Then I have future growth. For the next 5 years, that future growth adds value as well because I'm making more than my cost of capital. So I take the value of the projects I take in year 1, year 2. So basically I'm taking the excess, only the excess value created and discounting them back today. I stop after year 5. Why? I continue to grow, but there's no value created, no additional value created because I earned the cost of capital. I add those numbers up, the value that I get for this company by taking the present value of the EVA and adding it to the capital invested is 170.85 million. To make it sound more fancy, I'm going to break it down and say 70.85 in additional value comes from excess returns you earn. That's an EVA valuation. Here's the same company valued using a traditional DCF. I took exactly the same information, did it the way we've always done it. Take after-tax operating income, there's the net capex, and I take the terminal value. I discount the cash flows back at the cost of capital. So basically, this is exactly the same company with free cash flows to firm and a terminal value, and the value that I get for this company is 170.85 million. All that's different is when I do traditional valuation, I discount the entire cash flow. In EVA, what did I do instead? I took the capital invested and made that my base and just added the present value of the addition. It's mathematically, if you work it out, it's exactly the same number. So my point is, don't look for, there is no finessed way in which you can get to a better valuation. Ultimately, you've got to deal with the same question. The one good thing that EVA did point out was to create value, what do you have to do? You have to make more than your cost of capital. And to the degree that CEOs had forgotten that very basic concept, it did remind them. And it said, look, if you have a market value out there, the market value will be higher than the book value for companies that can earn more than the cost of capital. It'll be roughly the book value if you earn the, in fact, that's exactly how we got price to book ratios, right? So essentially there was nothing new about EVA, but it was sold as something that could change companies. I've had I used to have a long-standing argument with the EVA people. They're now all gone, so they can't even argue with them anymore. Okay? But it was founded by two guys, Joel Stern and Bennett Stewart. And Bennett Stewart was an incredible salesperson. He could sell refrigerators to Eskimos. And he went around the world selling people on EVA. And I remember the first time I ran into him, I was in front of a bunch of European CEOs. And Bennett gets up and he holds up an annual report, a Coca-Cola annual report. He says, do you want to be like Coca-Cola? This is the glory days of Coca-Cola. All the Europeans say, yeah, yes. Coca-Cola uses EVA. It's like one of those high school logic things, you know, A, B, B, C. Yeah. So yes, yes, they do. So if you use EVA, you'll be like Coca-Cola. That was the entire pitch, and he sits down. People line up like, no, I want to be like Coca-Cola. All I have to do is use EVA. Pissed me off no end. The next time was about a year and a half later. I was somewhere in New York. I was going to be with Bennett again in another presentation. I knew he was going to do this Coca-Cola pitch, so I came with my own pitch. My own props. I came with a couple of Nike shoes, Air Jordans actually. So he does his pitch, and then it gets my time. I don't even get up to talk. I take my Air Jordans, I put them right on the table. People saying, what's this guy doing? I take my shoes off, and then I put the Air Jordans on. So can somebody point me towards a basketball hoop? I want to slam dunk a basketball. I'll have to tell you, my leaping abilities is that of like two inches off the ground. I can't even get to, I mean, a Fisher-Price hoop maybe, you know, one of those kids. I can wear the most expensive Air Jordans in the world, but I am not going to slam dunk a basketball. Just because you adopt EVA, you don't get to be like Coca-Cola. What made Coca-Cola special in their glory days was their capacity to earn well above their cost of capital in every part of the world. That's not easy to do. That comes from having a brand name and doing something right. Adopting one of these metrics is not going to do it. But here's the reason it was so damaging. People not only bought into EVA, They then tied management compensation to EVA. And the last part of the session I'll let you look at, but it's actually very simple. If I make you a CEO, and then I tell you your compensation is tied to the EVA and extra, I'd like you to, and this is a very perverse exercise, I'd like you to think about all the ways you can increase EVA while destroying value, where you get a bonus and leave me with a, and that's exactly what happened at companies, is people started to game the system. They figured out what drove EVA, and they delivered the higher EVA, and in the process destroyed value. So remember to get your summary sheets to me on Monday. I would send you a set of slides about probably 20 minutes before class, because that's when I'm going to be done with them. So it'll be as a PDF version, so bring those slides with you when you come to class.
You need help rewriting the. Oh, you do. Yeah. I have a question quickly on this. When they're thinking about spinning off a company, right? You said when they spin off the work division, sell. Why wouldn't the remaining companies, say there's two companies, the good one and the bad one, why wouldn't the good one re-rate to that price that they would get if they were to sell anyway?
Okay, whatever the value is, the healthy pieces plus the cash and fees on the divestiture. So
Right.
think of before and after, right?
Right.
Before, the value of the business is 200.
Right.
The value of the back business is, let's say, only 25, right? So it's 225.
Right.
You sell off the back business.
Right.
The 200 is still the 200, not,
Right.
but the 25 now gets replaced by the cash received from selling. So you know what the value of the business is going to be coming from the after the divestiture. It's going to be the 200 for the good business,
Right.
plus whatever cash you got
Right.
from the divestiture. Your value change will depend on whether you got more or less than 25 from the divestiture.
Right.
Here's my point. You're trying to sell a bad business. What makes you think somebody's going to pay you more than 25 for that business?
Well, but here's my point. If you sell the good business, what makes you think that keeping the bad business with cash is not going to make the cash trade at a discount?
Well, because the bad business is already invested, right? So basically, after you sell your good business, you're going to get hopefully more than the value of the good business. And let's say each good business was trading at 100 million. You sell it at 150 million. You hope, you're right, that 150 million
Yeah.
now leaves the company,
Yeah.
but the value of the company increases right after the divestiture.
Right.
Remember, as the
Right.
CEO, hopefully you were brought in because you didn't trust the old man. So this is why you should always come back to a new management. And my point is, when a new management comes in, the best future hopes are always built around the back business. I want to get rid of the back business. If I'm GE, the chances of my getting rid of GE capital are close to zero. If I try to give away GE capital, I'll probably have to pay somebody to take GE capital off my hands.
Right.
But if I try to take sell GE and our pensions, maybe
Right.
people are excited about this business and they pay a 50% premium, but it's about what you can get on the divestiture versus the divestiture.
Right. Yeah, it gets nuanced. But like when I looked at a company, Perry Ellis. They had Perry Ellis, which was like the crown jewel, and a bunch of other
I
businesses.
tell you though, there's no problem in doing that. Just don't act like you get the That's
No,
basically.
no. But what happens sometimes is that you don't pay taxes. So like, because if your cost base is really low on your crown jewel, right, and you sell it, you're gonna pay a lot of taxes on that. But on the bad business, which is typically acquisition for this company, you end up not paying the tax because you're selling it below what you paid for it.
That's a separate issue.
Yeah. Right.
Two quick questions. One, location for the early exam. Will you be sending that out?
The 14th?
Yes.
It's going to be possible.
Oh, it's here. Okay.
Once you get to about 70,
Where we can like split it up.
basically that room fits only about 70. So